Hey guys, Freaky Finance here. Last week we looked at Weight Watchers, and this week we're going to look at Paramount. Also, I want to bring up, I got a green screen behind me, so we'll see what I can do with it. It's new, so should be fun when I play around with editing it. I did notice that the green guitar picks up whatever background I put on the green screen, so anyway, let's get into it. So I did a video on Paramount a long time ago. I did own it. Actually, one of the reasons why I'm doing it is because it's getting cheaper again. I like to revisit things before I start considering adding again. And it's also important to do videos on ones where I'm actually down, right? So definitely not perfect. No one ever is in this game would actually do it in real life. So you can see Paramount, I'm down almost 50%. It's been probably my worst call last year and so far into this year. Anyway, let's get into it. Perhaps what I missed and kind of what I'm thinking, where my head's at, and then I'm going to listen to this video again after and kind of think, like, where am I wrong kind of thing. So anyway, I did a video before in this if you guys need some more background on it, but basically you have a decent amount of content here. South Park, Comedy Central, MTV, BET, Star Trek, Paramount, you have Nickelodeon, so SpongeBob, stuff like that, Pluto TV. So quite a lot of stuff anyway, CMT. And if you just look at the annuals, you'll get an idea of why it's getting crushed, just because the earnings per share has been collapsing. Now, I listened to my old video to kind of think where my head was at. And back then, I was like, well, how's the market going to treat this? Because you're going to have DTC growing, but you're also going to have the earnings per share decreasing because they're in investment mode. I got my answer. It does not like it. It doesn't matter what the growth is. If the market's treating you like a declining linear business, that's what you're going to be treated as. It doesn't matter that you're growing on the other side, especially at the cost of current earnings per share. But anyway, you can see that the decline year over year in terms of adjusted EPS was down 70% from $1.70 to 52 cents. This company actually was putting up closer to $5 in earnings power when it first merged with Viacom and CBS together. So it has come down quite a bit. Here is Paramount's rough slate. So 200K TV episodes, 4K film, so quite a decent library. They're actually pretty strong in kids, right? You have Dora, SpongeBob, Rugrats, Paw Patrol, and Teenage Mutant Ninja Turtles, right? We know Mean Girls and Bob Marley did okay because they're so cheap to produce. They actually are profitable, whereas we've seen lots of bigger flops with bigger budgets. They do have Daily Show, Yellowstone, so a decent amount of content. Dexter, I like. NCIS is very big for the older demographic. Billions is there too, pretty good. A lot of different content. You can kind of get the business models making content and getting advertising dollars. In terms of the business model, we'll talk about the three segments. So they have TV media, direct-to-consumer, and film entertainment. Now, in terms of importance, the cash cow is TV media. The investment phase is direct-to-consumer. In film entertainment, it gets a lot of grab because people would see these things in theater. It gets a lot of marketing. It actually never really drove that much OIBDA for the company. You can see here the networks. We already talked about them briefly, but you can see kind of how they divide them out. But really, in order just to understand this business, you have cash cow, you have the investment Paramount Plus. So now I'm just going to go through the segments really quick. And this is the cash cow. And this is the reason why the share price has been declining slowly over time, is the linear advertising has been very bad over the last 8 quarters. It's a downtrend no matter what because of cord cutting. People understand that. And that is one of the reasons, that's why they're doing it. All the streamers are coming out. It's because they're trying to stop the bleed on their linear network and go direct to consumer. And we do see that pressure over time. The lower your views are, lower your ratings, lower ad dollars you're going to generate. Now, this was exacerbated in 2023 because of the strikes. And there's also a couple things I think are happening here. And this is probably one of the things I got wrong is the rate of decline. I thought it'd be relatively linear. I also thought, because we started seeing digital, like I started seeing my Meta investment and other digital advertising businesses start doing better. Even Uber started picking up advertising. And I thought linear advertising would come back, and it just hasn't. Normally it would follow digital on a leg, and this time it really hasn't. And there's a couple things here I'm thinking. So one, I wouldn't know back then anyways, is how big AI is becoming relatively quickly. It kind of goes back, if you listen to the Pinterest video, it's the advertising matching. So I think AI is helping the ROI of digital advertising better than linear. And you could kind of see that, like I just put some examples here for advertising, but on Nestle's call a bit ago, you can see they're basically saying there have been some changes to everyone's marketing mix. Of course, our share is much larger digital now, and it's fair to assume there's a higher degree of productivity. So again, getting more bang for the buck on digital advertising than traditional. And they also did say they're a little bit below marketing in general, which means there could be some easy pull here still on the linear side. But we're definitely seeing digital outperform linear even more than what I thought it would. Now, part of that, again, is hard to know. Like, I don't expect linear to keep going down 10% year over year in advertising or more. It's not like every quarter is going to have a comp with a strike, right? But it isn't a good trend long term. It is secular. So it's important to understand here. Here's another one on Darden and Olive Garden, which I thought was kind of interesting. So marketing traditionally has always been hard to know what your return on ad spend is, especially for traditional channels, think radio and TV. Whereas digital is always easier to kind of show an outcome. Kind of you spend this, you can expect this kind of thing. And what happened during COVID is that when they turned on their marketing, they were able to see the return on ad spend easier than they ever could have before, because it was going from nothing to something. So you could market, basically you could try to see the rate of change on your return on ad spend. You could see digital was relatively superior. I think that's also what's happened, is both the COVID and the AI overlays have accelerated the digital advertising push quicker. That's not going to be true for every company, but I just wanted to point that out, that this is something that I'm starting to see more of, and it's something I should have thought of back then, at least on the COVID side. Here's a fun one. So direct to consumer is inflecting. So we've seen quite a lot of losses. So where's that slide? It's a good comparison. So here you can see the cash cow is bringing in 4.8 in a relatively weak year, and DTC was still burning 1.7. You can see this is a huge eat, right? Just imagine you're making 4.8, you're spending 1.7 just here. Now they're expecting this to go to break even by 2025, which would be relatively huge in terms of EPS boost if they can stabilize this business, right? And so you're kind of in this race now. The market's not sure how quickly TV media declines and how quickly they can get DTC to profitability. It's kind of like this little race. And that isn't to say that 2023 was bad for Paramount on DTC at all. It was actually, my eyes have actually outperformed. It was just the TV media declined even quicker than I think people were expecting. And part of that is strike related, which makes it hard to know. But we have started to see, at least in the last 2 quarters, the losses have peaked out year over year, and we're already starting to see that trend back down. So 1.8 billion in losses to 1.6 billion in losses, guy in 2025 break even, which implies this loss should just argue get cut in half in 2024. So be like another burn, let's call it $1 billion next year. So what we should see, or at least what I'm kind of thinking in my head, is you see DTC down $1 billion, and you see TV media maybe at like 4.6 or something, or 4.5. And that means we're actually going to see an inflection in EBITDA as well year over year. Now, it could be more than that. It's hard for me to know where TV media ends up at. In terms of the subcount and the revenue, you can see it's gone from 1.3 billion, so almost nothing for the company, to 4.4 billion, relatively something for the company. In terms of the TV media side, you can see that they did put up 20 billion still in revenue. Just small. 20 billion in revenue still on the TV media side, and only 4.4 on DTC. So you can still see that it's still small relative to the cash cow. And I think that's also a reason why the market's kind of scared. Because that is still small, even though it's growing quite a bit, right? It's literally gone from 1.3 to 4.4 in just 8 quarters. So, and the subcount is also impressive, especially relative to others. Now, part of the reason why it's bigger than others is because it's because Disney and WBD both kind of pulled back earlier, because the other ones pulled back more. Paramount looks better because they kept spending a little bit more on marketing, or at least that's what I'd argue. And ultimately Netflix is just chugging along just fine. TV media, we're not going to spend too much time here, because you can see even in good years, we're talking 207 million, 272 million. It won't be a needle mover for my eyes. I don't expect theatrical to make a comeback. Really what they're doing here is they're trying to make content, make it semi-successful, or make a hit. Like you can have Oppenheimer, Barbie, and Dune, I think, will be good. It's coming out this week, but you can see it's not a real needle mover in terms of profitability, even on good years. So that's a Top Gun right there, and it still barely moved it up. So I view this as just a way to get eyeballs. Like, it's a big marketing push. You get a lot of attention, and you can put it on your platform and hopefully get subs. It's a way to acquire subs, and technically, if the movie's good, you can actually acquire subs at a profit, right? Instead of paying to get subs. So something to think about. It's not over here there for me. I don't expect the actual to come back. And I say that when I show that I have quite a bit in IMAX. But again, if you go by the IMAX video, it's not about the attendance coming back. It's just how the business model is just so superior, and they're already putting record numbers without 20% of the people in the theaters. Just of how they're positioned and how the business model works, I just think IMAX is I'd call it a pretty solid business, ultimately with a very decent balance sheet too relative to peers in the industry. But that's neither here or there for today's video. In terms of debt, you hear this a bit, especially on WD. Warner Bros. Does have quite a bit of debt, but Paramount, I'd argue, does and doesn't. So it does have it, as in you can see it there, 14.6 billion. But it is going down, and you'd be like, well, how's it going down if they're investing so much? Part of that is they're still able to make money last year, and a part of that is they've been selling down non-core assets. So they sold Simon & Schuster for 1.6 billion. They sold the BlackRock building in 2021 when it was still Viacom CBS. And then they also did what I thought was a cool raise back then, is they took advantage of the stock price shoot up. You'll see that when we go through the stock chart. Just went crazy in early 2021. And they did a share raise, which basically allowed them to park. Again, one of the things that people don't think of when they think of share prices is actually a source of financing for the company. And they issued shares it was peaking. That gave them even more ammo for this DTC push that they're going through. Now they are chewing on that cash still, but it's one of the reasons why the balance sheet is held up so well during this DTC push. And in terms of this financial statements, again, it looks really bad. Earlier I talked about the 70% decline in EPS and the long-term trend going from 5 to 4, and it spikes a little bit. This is accounting one, so it's not adjusted, so it can be more volatile. But you can see, regardless, you can see the trend goes down in the last couple of years. Now, what I find very funny is the estimates for the next 2 years. Basically, analysts are expecting EPS to double, expecting to go back from 50 cents to $1. Fine, but I just think it's extremely low. I mean, for record, in this year where they put up 1.7 adjusted, 1.6 gap, they had 1.8 billion in DTC losses. It's just, I think the expectations are washed out here. And even the next year, like we're talking like 1.3 EPS. This company is doing 1.7, like I said, with 1.8 billion in losses in DTC. In 2025, they're expecting break even. So if we assume everything else constant, which is always dangerous, but if we do, you get in a situation where they have to be assuming, either DTC doesn't get back to profitability, or get to profitability, or they expect TV media to decline by 1.8 billion over the next 2 years. And when I looked at TV media over time, you can see it's in a decline. The decline hasn't been crazy, right? We're talking 10.1, 9.3, 8.1 on advertising, but on the total revenue for TV media, you're going 22.7, 21.7, 20, right? So maybe something like between 5 and 10 every year. In order for me to get OIBDA to go down 1.8 to wash out the DTC going from minus 1.8 to 0, I would need basically TV media to decline by about 50% over the next 2 years to get to the analyst expectations, the average. So, and I view that as unlikely. I asked ChatGPT to be like, okay, what is the standard deviation of this probability, right? When you're normally declining 4 to 10, and then I say, okay, but the next you expect a sudden decline of 50% in 2 years. What's the standard deviation out of that outcome, right? Against that average. Basically, it says 2.5 standard deviations away from the mean, which would imply that it's very improbable, right? Given the bell curve, right? That basically would probable 0.3 to 5% chance of probability that the analysts are right with their expectations being this low. And I again, just in my head, I'm like, okay, that's too bad to be true. Now, it's not that simple. I'm kind of handicapping that kind of assuming DTC does get break even in 2025 with this math anyway. So it's worth bringing up. I just think it's going to be I'll be surprised if I go back to this video and Paramount actually only puts up $1 in 2024 and only $1.30 in 2025. Be very disappointed. And there's a couple of reasons why. It's not just me thinking math. There's a couple catalysts here. So the ARPU has been going up. They did raise prices during Q3, and we did see that is also coincides with the time where the losses in DTC stabilized. So you can see that here. Increased ARPU by 31%. They're guiding for a 20% ARPU expansion. Like, how can they raise prices? Well, because they're so cheap right now relative to peers, so they're just going to raise prices like how they all are. Netflix already did up twice. And they're all going to do that until the business is profitable. You can see the effect here. Now, I didn't double check these numbers, but the trend makes sense. The actual degree of increase, whether this is 4.4 to 5.7, I can't tell because it's hard for me to actually reverse engineers Paramount's numbers based on what they disclose. So, but it's worth bringing up. That is kind of the trend that I'm seeing, and it does make sense in line with the numbers and what they've actually put out in a news release. Here's basically what they're doing with content. So they're not just producing most things like Disney, WBD. They're all pulled back content. Paramount's also pulling back content, but really they're trying to make content cheaper to produce. So still make good content, but just make it cheaper. And you can kind of see some strategy here on the movie side. You can see the Mean Girls and Bob Marley both working on both lower budget, right? And they improve the financial return. And then on TV media, you have low cost formats like unscripted. So this is something WBD, Warner Bros. Discovery, especially Discovery, has done well in the past with unscripted reality TV stuff. And Paramount's also doing that because it's cheaper to produce, right? This content here, cheaper to produce unscripted. And then you have shot abroad as well. So they bring up the example here of NCIS for Australia, for Sydney. They call it NCIS Sydney. Much more efficient price point. It was the most watched show this season on any network in the US. Worth bringing up, that's kind of the strategy for content. So we should see more efficiencies on that production side and the DTC side relative to cost. We are seeing some signs of stabilization in the ad market, but I've seen this before and it's been a head fake, so I'm kind of afraid. But so I'm not assuming that linear actually flatlines. I'm always going to assume linear is going down because it always has since cord cutting's been common, right? They are seeing healthy scatter premiums. That's worth bringing up. Interesting enough, they expect low to mid-teens advertising growth in Q1, but that's because they have the Super Bowl. Now, that's another funny thing with the estimates is like, okay, you're barely going to beat last year and you have the Super Bowl this year and you have DTC losses being way lower than they were a year before. And you have headcount reduction, which is going to move the cost from salaries to restructuring below the line, right? So the analyst expectations for the next 2 quarters of Paramount make no sense, especially when you have their actual cash cow growing for a bit because of basically Super Bowl defying gravity. In terms of political, so another thing that's happening next year, or this year, 2024, is the election cycle. So here you can see, again, a normal downtrend. Right, 2020 versus 2019, you see basically advertising down in TV media. That's always fairly steady. Cord cutting is real. But then you have, for a little bit, you defy gravity, and this is in Q4. What happened in Q4 2020? The election. So basically, again, election defies gravity. So you have 2 quarters for Paramount in 2024 where you're defying the gravity of linear decline. And obviously, it's not in expectations, or at least not in my opinion. Here's another strategy thing that I like. So basically, for say Yellowstone, they'll use the older content, or the core content. So Yellowstone was a hit, put it on CBS, and then they'll drive say 1888 to Paramount Plus, and basically they bring the new audience from linear cable to the Paramount Plus. That's the strategy, right? You basically link it, and they're going to do the same thing with Tulsa King. So first season, Tulsa King CBS, second season premiere on Paramount Plus, and they'll do it ahead, so stagger it. So basically amp up the demand and release it on Paramount Plus. And we've seen a strategy like they also did it, like they'll also do it for like the Amazon distribution. They'll do an Apple TV. They'll do the same type of thing on Netflix as well, even for very older content, to try to amp up their new content spinoffs. And so there's kind of like the idea, in theory, when you see Yellowstone, put it on CBS, or Criminal Minds, put it on CBS, then put the upcoming spinoff on the Paramount Plus. So 1923, Criminal Minds Evolution, that kind of stuff. So that's the strategy in motion. Headcount reduction. So here is they are reducing 5% of domestic employees, which expects 200 million. Now, how write-offs work is basically you debit restructuring charges, credit the salary expense. So salaries actually look down, but the accounting hit is still there. So Q1 is going to be hit with the restructuring charge, which is that it's below the way below line. And it's worth bringing up that they do have a programming charge as well for 800 million. They actually had an even bigger programming charge last year, and that's them also reducing content cost. They also, one of the things halfway through 2023 is they brought in Showtime into Paramount. Before they actually had different platforms that they were trying to market, have different price points. Basically, they bring it in. What that did so far, they have been able to raise prices, and they've seen very limited pushback. They actually saw engagement go up. And we've seen that with all the streamers, really. They're all afraid to take price, and when they do, like even Spotify, take price, we see the margins go up, and you see very little churn. Maybe there's some in that initial response, but afterwards, people just accept it. So we did see monthly churn actually improve, even though they raised the price, and I think that speaks because they tucked in Showtime. I don't know that. It could just be people are not price sensitive at these lower price points, but we'll see. But I just thought that was kind of interesting as well, because I was kind of worried about that, especially during the strikes. I was like, okay, they're raising prices. Well, there's no content. I was expecting churn to be bad this quarter. It wasn't at all, so that was kind of surprising to me. And this is probably the frustrating part is when analysts ask, like, hey, what does significant EBITDA growth 2024 mean? The management team never really told them what significant means, and that would imply that maybe they don't know. So while they might be guiding to significant EBITDA growth, and technically analysts have expected 100% EPS growth in 2024 versus 2023, I just think that it's, if they only get $1 in 2024 and only $1.30 in 2025, I'll be like, what? How did you mess that up? Because this should be, in my eyes, it should be like a $2 EPS story no matter what. And if they can break even while holding back TV media's decline, actually they can get back to like 253 quicker than at least what the street thinks. But that's just my opinion. Put it out there for what it's worth. In terms of content slate for 2024, you have a bit. So you had Halo, Mean Girls, UEFA, March Madness. You got Masters, Bob Marley movie that they can put on Paramount Plus. Star Trek Discovery, MTV, Dora's, Sonic Spin Out, Knuckles, right? And then once things start rolling better in the back half because of the strikes take time to work through. And they reference there, you got SEAL Team, Tulsa King, Fraser, right? And this was kind of fun. So they try to talk about, because M&A is getting all the headlines now, right? Basically, Paramount for sales, kind of like the narrative. Man, it reminds it should have been for sale the whole time. Should have been open to it anyway. Anyway, here Bob is saying, we're always looking to create value for shareholders. And to be clear, that's all shareholders. He didn't have to say this line, but I just thought it was funny. Because what we're seeing, this is worth bringing up, is there's two share classes for Paramount. There's the voting control, which the Redstone family owns, Sherry. And then there's the common shareholders, which I'm in. And normally they would trade very close together. But then all of a sudden, right around, well, really in December, and then it was brought in even higher in February, like crazy high, the biggest it's ever been, spread between the two, is the voting control. So all of a sudden, the voting control is getting a premium here, which implies the market is starting to think that someone's going to buy the voting control. It's basically take over Paramount while paying a cheaper price, and that would allow them basically to divide out the things that they want. So they buy Paramount cheaper, they have voting control, they get to what they want. They say, okay, you get BET, you get MTV, this place gets that thing, right? You can just sum of the parts and make money. And potentially that could screw up the common shareholder. I think that's kind of what's happening here. And I'm going to revisit this. I'm sure this is going to be something that I'm going to go, how did I miss this when I watch this video? But technically at this time, I don't know. But the spread is interesting here. So basically, the market's starting to price in that the voting control is going to start being worth a lot more than what it currently is, especially relative to common shareholder. Which is kind of interesting, and maybe that's why Warren's starting to sell some. I mean, he still has a 10% stake. And here you can see that well, he did sell some, still 9.7, so a decent amount of ownership. But yeah, it's definitely a fun one. And this spread is very interesting to me. We'll have to see if this is indicative, if it actually does mean that like, someone decides to buy the Para A voting control and not pay a similar amount to the common shareholder. But again, you could be opening yourself to a lawsuit there. But I did check, and there was no coattail provision, so someone could do that. I think that's what the market's picking up. But anyway, I'd like to know your thoughts on Paramount. It's a fun one. I know I've done this video before, but it's just because it's so low, it's getting close to the lower end of the Bollinger Band as well. It's like, you know what, I got to do this video because there's something here. So it'll be fun to rewatch this. Anyway, hope you enjoyed the video and have a great rest of your weekend.